welcome you all to another exciting day at SACEF. We saw a lot of excitement yesterday, a lot of launches that happened, a lot of discussions. Again, the theme of engage, act, and solve, I think, was very much, demonstrated yesterday. So here now we start off with our first session on financing clean energy transition in South Asia. During the session, we'll have a presentation on the overall theme on investment landscape for South Asia, and then we will have a panel discussion. We have some elite panelists amongst us here on this, and who will actually discuss primarily on how the financing can be accelerated in South Asia. So with that brief context, I'll now invite Apurva Chaturvedi, Senior Clean Energy Specialist from USAID, for the welcome remarks. Apurva.
Good morning, everyone. Namaste. And again, a warm welcome to the third day of SACEF. As Mayank said, a lot of action going on in the last 2 days, and we just want to materialize a lot of things. And financing would be one of the key enablers to actually put those ideas into real-time actions. I mean, it's something that is cross-cutting as part of any portfolio. Why just clean energy? So if we look at the need for financing from now till 2030, from $270 billion, what stands today as the requirement for clean energy deployment, it would actually become almost 4 times to $870 billion by 2030. And this does not take care of the cooling investments required to keep that 1.5 degree pathway on track. That would require a massive 1.6 trillion by 2030. So just laying down these numbers because they are giving us a scale of investment that would be pumped in or required to make the clean energy transition actually happen. So that if that transition has to be the real thing, then we need that kind of investment. And therefore, it's very imperative for global partners and institutions, governments and industry, financial institutions, to provide a very well-coordinated, financial and technical package to accelerate this, transition in the region. And if we look at different kinds of financial instruments, just concessional financing or grants will not be enough. And I think all countries are already witnessing that the concessional grants that come from various DFIs is not sufficient to meet the requirement of this quantum of investment. And therefore, concessional capital has to play a role in mobilizing private capital and guide investments across various sectors identified under this clean energy space. We'll require commercial debt. We will also require equity investments, and we'll require different kind of investment types, from family pensions to commercial investors to concessional, loans. I mean, various types, impact investors, all kinds of investment types to be able to help achieve what we are intending to. Also, if you look at the different technology types, when you talk about solar PV, when you talk about energy efficient appliances, cooling technology, or e-mobility, or green hydrogen, they are all at a various degree of maturity in the, in that curve, and would therefore require different kinds of instruments to prop them up. So, for example, in e-mobility, it needs the initial support in even setting the wheel rolling. It's considered very risky, high risk for the investors, and therefore when they are expecting a good commercial return, perhaps that's where the issue comes, that most of the investors are not ready to invest. So how do we crack these problems? how do we address the issues of different sectors at different maturity curves and bring in the right kind of investor to the right kind of sector. We also need some credit guarantee, to actually to mitigate the risk associated with the high risk subsectors within the clean energy space. For example, if you see, very recently the Government of India set up the payment security mechanism for electric buses, which mitigates the risk that the operators and the manufacturers of e-bus face while they work with the state transport undertakings considered as very high risk stakeholders. So this session today will facilitate some very actionable discussions and strategic planning for financing this clean energy transition in South Asia. The focus will be on identifying some very clear investment opportunities. It will discuss what has worked in the financing space, what kind of practical financing instruments are needed to reduce the cost of capital, so that this discussion actually contributes to this entire, different sessions of SACEF on different aspects of clean energy, all which require huge investments to go in. So looking forward to a very interesting deliberation today and very identification of very clear actionable items that we can take forward. So thank you so much and have a great time.
Thank you, Purva. So, yesterday we had the launch of the Clean Energy Investment Facilitation Platform, through USAID, which has been developed by USAID SAREP for connecting the investors and investors. We just have a short video. We'll just play it to take you through how the platform is unique and or what it actually intends to do for accelerating the finance in South Asia. So can we just have the video, please? Thank you. So with that, we'll move on to the next section. So we'll now have a presentation on the investment landscape for clean energy transition in South Asia. I'll just invite my dear friend, Aishwarya, to just take us through the presentation. Aishwarya, over to you.
Missed a step, sorry. Well, that was a good start to my presentation. I'll try to make up for the rest. Shall we? My name is Aishwarya Kachal. I advise USAID on driving clean energy transition in the region. And I have the toughest of tasks today, which is to set the context up for the panel discussion on financing clean energy transition in South Asia. The ask is tough because I see the panelists in the front row and I see the audience, and all of you have experience of deploying gigawatts of clean energy and deploying billions of dollars in the sector. And my ask, the ask from USAID for me is to frame the context for this presentation, and that's why I would say it's a fairly tough ask. Globally, since 2020, there has been an uptick in energy investments. The number has moved from 2 trillion to 3 trillions in a span of just 3 years. The better news is clean energy investments have gone up from 1.2 trillion to 2 trillion, or the other way to look at it is whatever the world was investing in energy in 2020 it now invests in clean energy. Bravo, that sounds like a great news. But for the region that we are in, I do not have such a good story to share. Two-thirds of the people in the planet live in this region. They consume one-third of world's energy, and they account for 60% of the world's emission. And that is why, you see the capital that is flowing into the region does not commensurate with the problem that we are trying to solve. Even though, you look at capital flow in India, look to be growing at a fair pace, but let me put this into perspective of what is required. Economist estimates that we need to put in something like 170 to 200 bill annually to meet the 230 renewable energy target for India. And let me also reference this with the size of the banking industry in India. The banking industry in India roughly today has 3 trillions of asset. And if you look at a number of 200 bill over annually, it tells you, the stretch that the banking system is sitting on. And, it requires a lot of deliberation and a concerted effort from all of us to make it happen. Now, if I were to just stay focused on the present and the supply of money, I would not be doing a good job of framing the problem. So demand for energy has increased by 50% in this century. And with the rapid economic growth, urbanization, challenges around cooling, this will only go up. And the other news that the other data point that we ought to think of, energy is largely comes from non-renewable sources in this large populous country, populous region. India and Sri Lanka are predominantly India and Bangladesh are predominantly non-renewable. Sri Lanka has done a good job though, a good mix of renewable and non-renewable sources. Bhutan is predominantly hydro. While NDCs are a future goal, high emissions and climate disasters that we are staring at in the region make it a very here and now problem to be solved. This slide clearly tells you that we are looking at a tough ask. India today is at roughly 200 gigawatts of RE, needs to go up to 500. Bhutan, the current visibility of 5 gigawatt needs to go up to 25 gigawatt. Sri Lanka is half renewable, needs to go up to 70. Bangladesh is 2% RE, needs to go to 10%. Nepal is 2.8 megawatts of hydropower today, needs to go up to 13 and a half. And Maldives has a low base of RE that also needs to go up significantly. The opportunity is large. Any ways which you look at it, it's a large problem to be solved. All the large PE, infra, sovereign funds have reasonable sized platforms. Brookfield is probably the largest one of them. They have a $3 billion portfolio in the region. They want to triple it in the next 3-4 years. Eversource, represented by Satish today, has 2 large renewable platforms, Ayana and Radiance, and of course, Greencell on the EV side in their portfolio. All oil majors have participated in the renewable story in the region through a primary or a fund route. Shell has chosen a primary route. BP has chosen the fund route. Total has a JV with one of the large industrial conglomerates in India. The debt side has also seen a fair amount of participation. Most of the foreign banks have come in. Public sector and private sector banks and DFIs have taken debt positions as well. While there are strong tailwinds, it's tough to finance the sector because of multiple risks and challenges. countries in the region are facing all sorts of economic challenges, right from debt repayments to foreign currency shortages to high currency devaluation. And it is very tough to invest in times like these. India is often quoted as a shining example, but if you look at INR has depreciated by 27% in the last 10 years. Green taxonomies are nascent in the region, they need to be strengthened. And there are other risks that I'll also talk about in the coming slide. Uh, you know, Clean energy needs strong offtake, needs strong, let's say parties as well. And while solar is a shining example, other forms of other mechanisms of clean energy transitions are evolving, and the tech evolution is at different stages of maturity. Uh, so this is what's happening on the solutioning side. Apart from structural issues, several asset level risks also exist. And as I said, on the sources of energy side, solar ticks almost all boxes. Green hydrogen is on the other side of the spectrum. It's starting to tick a few boxes. Storage is rapidly evolving. By the next time I make this presentation, I would see a few more checks on the slide. EVs have started to tick many of the boxes, and we saw a session yesterday on e-buses. E-buses, two-wheelers, three-wheelers have taken off where the risks are increasingly getting resolved. So, and back to financing. See, credit ratings of countries in the region continues to be a challenge. Inflation continues to be high, currencies are getting devalued, and bank rates are also significantly high. Sri Lanka is at 10, Bangladesh, the repo is again 10. The repo rate in India is not cheap, is at 6.5, which I believe is one of the highest in the last decade. And the perceived risk for these new technologies is also significantly high. As a result, WACC for such project is high. It was 2x of what it was in developed markets like 5 years back. Now my friends in RE tells me that it is considerably better, but still high compared to all developed markets. And the challenge that we have to deliberate is when cost of capital is high, how do you fund this mammoth clean energy transition in the region? But that's an ask that I have for our panelists today. And they have to do the heavy lifting and on solving the conundrum of availability and affordability, and thinking how we can bring different pools of capital together and reduce the risk for each pool. What I will do today is leave you with some green shoots. There's a lot happening in the region, and if all of us were to continue the efforts that we are making today, South Asia will be a much better place to live. Thank you for your time and attention, and I'll leave you to our brilliant moderator and the awesome panel. Thanks so much.
Thanks, thanks, Aishwarya. I don't know whether I'm brilliant or not, but I'll accept it. Thank you. So now I'll move on to the panel. I think as a finance professional, it's always extremely exciting to listen to the asks of the investees, and what are their requirements, what are the challenges, and on the other side to have investors talk about what are their preferred choices on the transactions and the structuring and how it all comes together, right? at all the times it never amazes me. We talk about innovation in technology, we talk about innovation in other areas, but I think there is a lot of innovation that we have seen in financing which sometimes I feel is not recognized, especially on the structuring part, how two or three entities actually come together. One does a credit enhancement, one does an equity, one does a debt, and there's multiple choices, multiple options that are there, and countless case studies across Africa, Egypt, where people have actually come in and financed the most difficult of the projects, which at the start were not possible. So, with that perspective in mind, and with what Aishwarya talked about in his presentation on how to accelerate, I will invite the panel, the elite panel. So, first, I would like to invite MD Dasho, Shegwan Risling, Managing Director of Drug Green, one of our, I should say, major partners across South Asia. Thank you, sir. It's really a pleasure to have you with us. Mr. I'll invite Mr. Satish Mandana, Chief Investment Officer, Eversource. Again, no need to introduce Eversource. I think one of the biggest funds right now in India. Then I will invite Mr. Rajan Gautam, Chief Executive Officer of Hydroelectricity Investment and Development Company Limited, Nepal. Again, one of our major partners in Nepal, who has been working with us very closely. And then I have Kushal Agarwal, Light Rock India. Again, one of the biggest funds that is being put together by Light Rock. So Kushal, really look forward to your inputs on how to create. And lastly, we have Pratyush online. Unfortunately, he could not join us for this in person. He's the investment director and country head for Macquarie Blue Leaf. Again, a big name who is there. And lastly, Namrata Mukherjee, the moderator, chief of party for the USAID SARE program. So, yeah, Namrata, over to you. Thank you.
Thank you, Mayank, and we have a very illustrious panel with us today. Thank you so much, distinguished panelists, for joining us. Pratyush, it's a miss we couldn't have you in person, but we hope to have an engaging virtual discussion from your end as well. So thank you so much. We'll get right into it in the interest of time, and I will start with my, distinguished panelists from the region, from Bhutan and Nepal, and I'm going to start with Bhutan. Dasho, from your end. We know that DGPC is the leading hydropower developer in Bhutan, and you have an installed capacity close to 2,500 megawatts. And we heard from Honorable Secretary Dasho sharing yesterday that Bhutan has an ambitious target of developing 25 gigawatts of renewable energy capacity by 2040, which will entail significant investment of 26 billion US dollars. So given the magnitude and timelines for achieving this target, the first question to you, Dasho, is what are some of the challenges that South Asian countries, particularly companies like DGPC, are facing right now in raising international capital? So.
Thank you. Good morning to everyone. As Namrata mentioned, of course, Bhutan has an ambitious target, but I would put it the other way around, that it's not an ambitious target. It's a target we have to achieve if we have to ensure energy security for ourselves and also be a player in the region. We have been fortunate for many years that we have always been surplus in energy generation. But over the last couple of years, because of a huge growth in domestic demand, we find ourselves in a situation where we are importing substantial quantum of electricity from India during the winter months, which has issues of whether it will be available or not, first of all. Secondly, issues of the pricing mechanism, at what price are you going to buy that electricity from India during the times when you need. Our exports to India are actually tied to long-term power purchase agreements, whereas when you purchase from India, it is through the Indian energy exchanges, and therefore the rates, the tariffs at which you purchase tend to be quite highly fluctuating and sometimes not affordable to the Bhutanese consumer. We are looking at an economic development plan for Bhutan, including, as was mentioned by our secretary, the investments that we are trying to make into the Gelifu Mindfulness City, that over the next 15 years, our present demand, which has touched this year a little over 1,000 megawatts, will go to 4,000 megawatts. The way we are investing at the present time, and our investments are mainly in run-of-the-river schemes, hydropower projects. For a 4,000 megawatt demand by 2040, we need to have at least 20 to 25,000 megawatts in installed capacity. And that's the problem. You cannot invest in 4,000 megawatts. You have to invest in 25,000 megawatts. So it's not ambitious. It's a requirement if you have to survive. You did mention, of course, what are the issues that we are facing in implementing such a huge program. And I'm sure that similar problems are faced across South Asia. India, of course, is a very big economy. We understand that they have access to financing. There are bigger countries, other funds which are able to come forward because of the sheer size of India's economy to invest in the energy sector. But for small countries like ourselves, Nepal may be included, it's very difficult to get access to that kind of financing. And as you mentioned, the total financing that we require as of today's cost is 26 billion. As was mentioned by the speaker earlier, the costs are likely to rise because of inflation, because of foreign currency risks, because of costs of materials that you invest in going up in any case. You're looking at the size of our own economy. It's about 2.5 to 3 billion, depending on which area you're talking about. And you're looking at investing 25 to 30 billion dollars in the energy sector alone. Not looking at any other sector, just in the energy sector. When you look at it from that point of view, it becomes a huge hurdle in arranging that kind of financing on a number of issues. I think first of all, people look at the size of the economy and directly come and tell us that if you are going to invest so much money into your energy sector alone, that your economy is going to get overheated. You will have the Dutch disease. That was what we were advised in 2008 when we decided to do 10,000 megawatts by 2020. That didn't take place. The economy didn't get overheated, and look at where we are today. So it's a question of making the investments and not having to worry on actually overheating your economy. I've not heard of any country, at least in the South Asia region or in the Asia region, where the economy got overheated because of investments. I think that is something that we would like to convey to the international community, that investments in good projects is good investments. It's good for the people, good for the region. You should not be afraid that we'll get overheated, that our economy will get overheated, and that we will not be able to take care of that. Rest of the world are taking care of it. Look at our GDP. Look at our per capita income. We are nowhere near where the rest of the world is. That's the first question that we get asked. The second question that we get asked is, look at your country. $3 billion is your GDP. And look at where you are today. And look at your credit rating. We are poor. So is South Asia, most of the countries. Instead of looking at us as a region into which investments at concessional rates should be made, most of the world is looking at us as a risky place to invest, looking at our credit rating, and therefore the cost of financing is much more higher to projects that we do in South Asia than in the rest of the world. It's 2 to 3 percentages higher, and therefore it makes us ineffective, inefficient, and at the same time financially not viable and not competitive when we look at the market. Thirdly, of course, because we are in the South Asia region, where very little investments have taken place in foreign currencies, there is always that issue of foreign currency risk. As the speaker mentioned, in the last 10 years, the Indian rupees has depreciated by 27%. That means the cost of investing in a hydropower project or a solar project in South Asia has increased by 27%. Therefore, tariffs are 27% higher. Everything has gone up by 27%. And over the next decade, 2 decades, it may go up by another 30%, 40%. We can avoid that kind of depreciation only by making the investments that are required. You don't make the investments, the depreciation, the cost of capital, everything will keep on increasing, keep on getting worse. So I think when you look at it from that point of view, looking at the foreign currency risk and all, at least for Bhutan, when we look at investments, of course we are looking at multilateral banks, we are looking at investments coming from outside, but basically we are looking at India. India, and maybe in the future to Bangladesh. And when we look at India, the investments are in INR. The Bhutanese nultram is tied 1-to-1 with the Indian rupee. Nepal is also somehow tied to the Indian rupee. And therefore our risks, the foreign currency risk, Indian rupee is a foreign currency for us. The risks are much more lower than when you take dollars, yens, euros, and all those things. And therefore we expect that much of the investments will come from India. Hopefully in future some investments will come also from Bangladesh. But today if you look at the regulations in India, whereas the government of India can invest into countries like Bhutan and Nepal, it's a little bit more complicated when it comes to commercial debt financing by Indian financial institutions in countries like Bhutan, which are still to be resolved. Somebody put up a slide just now of the recent signing of a 14 billion Indian INR loan that Duke Green Power Corporation has entered into with State Bank of India. Took us over 2 years of negotiations to sort out all the issues. That's for 14 billion. You are talking about 26 billion, which will translate to 2 trillion INR. And when you're looking at that type of investments, it'll need a lot of discussions between the governments at in the South Asia region to ensure that these regulations, there are some easing of the regulations so that we can have not only easy access to financing, debt financing from India, but also being able to access the Indian energy markets for sale of surplus power from our countries, because the only way that we can sort of pay back this financing is through sale of the surplus power. And therefore the access to Indian financing, access to Indian markets, access to the regional markets will be very, very important. I think the fourth thing that comes to my mind when we're talking about investments is that I look at Nepal, I look at ourselves. We have done the world no wrong with all the climate change that's taking place, all the environmental issues that are there, the social issues that are there. We have remained poor. The rest of the world have moved ahead. But today, when you look at the requirements for us in terms of having to meet social and environmental requirements to keep the tigers alive, the leopards alive, the fishes alive, to protect endangered species, which we are doing quite well. We are committed to it. But sometimes the financing is tied to that. Bhutan has already committed to keep 51% of its land mass as parks, 60% as forests. But still, to take a project forward, it takes us 2 to 5 years to do the social and environmental impact assessments and to satisfy various stakeholders across the world that we are on the right path. Costs money, costs time, projects become expensive, and whether this should be something that we get tied to in terms of the sourcing of the financing. I think it's the chicken or egg situation. We want the egg, you want to preserve the chicken, or something like that, along that line. So I think there has to be a relook at South Asia as a poor conglomeration of nations, but of course with India moving much ahead of us. But if the global community is to come forward and help us to move some of the investments, some of the aspirations that we have, I think all of these 3 or 4 issues that I have pointed out in terms of financing our transition needs to be looked at very closely and considered not only by ourselves, but also by the global community. And I think that should be the way forward for us.
Thank you so much, Dasho. That was very, very comprehensive. And really some very important points, particularly the point on riskiness versus concessional nature of financing, not just for Bhutan, but for all of us in this region. And I'll come back to the investors here in the room to ask that question. But before that, I also have to remind all of our panelists that I'm a moderator. Sorry, so I have to wear that hat as well. I would want us to do 2 rounds of questions. So if all of you can stick to the first round to 5 minutes, then we can come back and also open up for audience questions. And I'll move to Nepal now. Mr. Arjun Gautam, who's CEO of Hydroelectricity Investment Development Company Limited. Mr. Gautam, we know that Nepal again has set itself a target of 30 gigawatts. I'm avoiding the ambitious term because Dasho literally told me it's the need, it's not ambitious, by 2035. And also certain interesting developments of Nepal signing the 10 gigawatts power trade agreement with India as well for over the next 10 years. Could you share with us a little bit the role of HIDCL in basically the clean energy investment landscape in Nepal, and what are some of the challenges that you are facing in raising capital from the rest of the world?
Thank you, Namrata. First of all, when we talk about the financing challenges or financing modalities and the financing in the energy transition, we have to put in mind that we are talking it for the future of the 1/4 of the total world population. Similarly, we are talking about the fundamental right of more than 2 billion people of South Asia, that the right of, the affordable and sustainable and reliable clean energy. That is a fundamental thing to be discussed when we talk about the financing. And another thing is that in the case of Nepal, Nepal is, as you know, the planning to generate 28,500 megawatt by 2035. And out of that is 15,000 for the India and the Bangladesh. So Nepal is thinking not only the energy transition of Nepal itself, but also we are planning to support to a neighboring country for their energy transition goal. So it should be the major agenda for the discussion while we talk about the financing. And in the context of Nepal, I would like to highlight 6 major financing issues, not challenges. financing issues which we face. Number one is the huge financing gap. As you mentioned that we are plan to generate the 28,500 megawatt by 2035. It needs at least the 46 billion US dollar, which is equivalent with the existing balance sheet size of entire bank and financial institution of Nepal, and which is equivalent with the total GDP of Nepal. So there is a huge financing gap. And so first challenge is the how to fulfill the financing gap. And the second is the financing modality. As already mentioned that the traditional financing modality like the concessional financing, like the government financing is not sufficient for the growing financing requirement. So there must be the new financing or innovative financing modalities is required to translate or to convert the long-term financing into the liquid assets. For example, if the bank finance in the particular project, it will be the long-term term financing, and if it is converted in the bond financing, it will be the it will be converted into the short-term financing or the liquid assets. So that type of the innovative instrument is required to meet the financing requirement. And the third thing is that the optimizing the internal resources, that is another issue, because in Nepal as well as India, there is a huge public fund like the pension fund, like the contractual saving of the contractual saving organizations, insurance fund. They mobilize the long-term fund, but they have no sufficient access for financing in the long-term project like the clean energy financing. So the third thing is the how to utilize the long-term fund in the long-term financing. That is also the agenda. And the fourth thing is how to minimize the financing risks. As you know, in Nepal, the total portfolio, clean energy portfolio goes to the hydropower. And definitely hydropower is suffer from the climate change risks as well as the other uncertainty like the hydrological and geological risks. So mitigating the risks is another issue for financing. And the fourth one is the ESG issues. That is also the major issue for the financing. And the last one is the regulatory mechanism, because when we talk about the public financing, when we talk about the private investment in the energy sector, there must be the strong and the renowned regulatory mechanism. These six are the major financing risks or issues which I want to highlight. And parallelly, I would like to focus some other agendas of the financing. When in that forum we are talking about the financing not only in Nepal but also the in South Asia. So I would like to highlight the 3-4 major agenda to be discussed in that type of the forum when we talk about the financing for the energy transition. Number one is there must be the regional cooperation on financing in the policy level and also the implementation level. Policy level means the G2G, government to government collaboration, and the that type of the collaboration is required. And the institutional level, like in Nepal, HIDCL is a dedicated financial institution. Similar type of institution are in the India, like the PFC is there, REC is there, IRIDA is there, and similarly the Bhutan and the other country are in Bangladesh. There is a school. That type of there is the collaboration between such type of organization to optimize the internal as well as the regional resources. And the second thing is that in South Asia, the common problem is that the South Asian country and South Asian people are suffering from the climate change risks. That is the common agenda of the South Asia. It should be the common agenda in the global forum for financing for the climate change. It should be the common agenda of the South Asia. And the third one is we have to talk and discuss to develop the appropriate financing modality for the regional cooperation. And the fourth one is that we have to talk about as our Dhidal sir yesterday mentioned that there must be the strong regulatory mechanism, and there should be the regional cooperation on the strong regulatory mechanism. And in last point is that we have to focus on the particularly regional cooperation between the BVIN, that is by developing the appropriate financing modality. As you know that in the yesterday session, our respected secretary sir has highlighted that the Nepal is inviting to the Indian investors in Nepal, because we are planning to generate the 15,000 megawatt for other country. So that should be the agenda. And another agenda is that we have already prepared some financing modality between the partnership between India and Nepal, like our Dinesh sir was highlighted that the petition was one example of the financing modality. Another example is the Arun Thor is another modality. On the basis of this modality, we can talk and discuss on the mutual cooperation for financing. Thank you.
Thank you so much, Mr. Gautam. So a lot of interesting points, particularly on the cross-border side that you've brought out, because a lot of Nepal's power will obviously, we've heard will be offtake to India. And from that perspective, some of these solutions from the regional side are some very interesting inputs. I thank you so much for that. We'll shift the gear slightly now and move towards our investors. And I will start with Satish Yu. Satish is the Managing Director and Chief Investment Officer of Eversource Capital. Eversource, Satish, we understand is a climate impact investor, and your focus areas are energy transition, industrial decarbonization, and sustainable urban sustainability, from what I sort of understand. I want to understand from you two questions to begin with, and if you can link these two for our audience and for the panelists here. One is, how is the investment landscape looking for you in the sectors that you're investing in right now? I mean, and it'll be good to understand, are you focused on India or in the region? Because we have a mix of participants here. And related to that, therefore, what are some of the key factors and prerequisites for you when you're investing in these opportunities? So let me hand it to you, Satish.
Thanks, Namrata, and good morning to everyone. We talked about the challenges just now. And the other side of the coin is the opportunity. And when Namrata asked how are we looking at these sectors and opportunities, to us, investing into climate or sustainability is a $1 trillion opportunity in India. And I don't see that as a CIO as a challenge, but as an opportunity. Climate investing, we have proven clearly, can be self-standing, remunerative, and commercially attractive opportunity to go in for. And though many of the things which requires initial support, a case in point will be the solar energy in India. When we started, there was a concessional support in terms of the offtake pricing allowed. But today, India can boast one of the lowest cost of the solar energy production in the world. And again, the scale has created similar situation in telecom in India, where we are the lowest cost producer of the per second talk time, which we do. So it's a big opportunity for all of us, and we need to change the perspective in the lens to say, and try and looking at the opportunity, then probably we'll find many more investors and many more people interested in getting into this particular regime over here. Over the years, over the last 5 years since we have been in the business, our focus initially has been in India. We are now raising our next fund, where the focus is not only India and Southeast Asia. And heading from both the co-participants over here, I really feel there's a huge opportunity which exists of collaborating with Bhutan and Nepal, particularly on the clean energy side. The second part of the question was that what do we look for when we invest? Obviously, we don't invest in any business which is not having a positive climate impact, because we are a dedicated climate and resource efficiency fund which believes in circular economy. So we invest into decarbonization of energy and its uses, as well as resource efficiency leading to circular economy. Our current portfolio entails investments into renewable energy, approximately 6 gigawatt capacity as we speak, investment into e-mobility, nearly 1,250 electrical buses and 2,200 electrical cars. We own and operate those. Investment into resource efficiency through waste management, where we are the leading producer of the renewable natural gas using all kind of organic waste, be it a organic fraction of the municipal solid waste, be it a agri-industrial waste like a press mud, or be it a agri-waste like rice straw. We're also into water conservation and recycling of the wastewater through another company. And we are also provider of the green finance, which is the biggest opportunity one has in transitioning the economy to green economy. We have recently created another platform for the energy efficiency, where we are doing the smart metering as part of the smart grid, and going forward, many energy efficient equipment getting financed over there. We look for 6 things when we invest into a business. And that thing is coming out purely as a commercially minded but purpose-driven capital manager. First and foremost we look for is the size of the opportunity. Gone are the days when people used to feel happy about a 30% CAGR. We are living in a different world now, which is not a physical world, but it's a mix of a digital and a physical world. And therefore, today the people are looking at exponential growth. All these digital companies have a capacity to grow exponentially rather than secular, scalar CAGR. So the opportunity of, for example, renewable energy is a humongous opportunity the country has. The energy transition is a humongous opportunity the world has, and we are investing into that. E-mobility, transitioning the mobility to an e-mobility, again, is a huge opportunity, and we are investing in that. So this humongous opportunity allows us to think and plan an exponential growth rather than a scalar growth. The second criteria which we look in when we invest into the businesses is that each and every business which we are looking in and investing in have to have Industry 4.0 as a part of its business model. When I say Industry 4.0 as part of its business model, what I mean is that an IoT or a machine learning or a AI is all embedded in the business model itself, rather than these being used as a KPI for improving the performance or tools to improve the KPIs. The third thing which we look at investing is that given a choice to invest into something which is going to produce a capital good, we invest into businesses which are having an OPEX model for the consumer, which means the consumer don't need to spend a lot of money to buy that particular service or good. Invariably, it's a service which we produce using a capital asset, and we believe we can use that capital asset much more efficiently than others, and therefore it is desirable to provide a OPEX model. So all our businesses, be it e-mobility or be it renewable energy or be it services in the environmental side, are all OPEX model for the consumer. And so we can penetrate much faster over there. Fourth, which we do, we require control in all our transactions. That was a part of the first fund mandate. Going forward, we are open towards a partnership rather than just a control. Fifth is that every business of ours has to have a resilience inbuilt into the business model. So if there's a black swan event of a COVID or something else happens, how do you pivot that business model in a way to survive is important to us. So we look forward to creating resilience at operational level, creating resilience at a strategic level, and at a management level. And lastly, everything being equal, we look forward to an opportunity which has got a better impact on the sustainability in terms of the carbon or in terms of the social impact which is going to have over there. And that gets the priority. So these are the 6 criteria which we have for investing into the businesses. Thank you.
Great. Thank you so much, Satish. You also spoke like a perfect investor where every challenge is an opportunity for you. And the 6 prerequisites are also, I mean, pretty clear. So thank you so much for that. I'll come back to you with regard to certain experience sharing because it'll be important for the audience to understand the types of investments that you've done which meet these type of prerequisites. So I'll come back on that. I'll just now trigger our online panelist. That's Pratyush. Pratyush, you are representing Blue Leaf, and I think it'll be important for our audience to understand a little bit about what is Blue Leaf. So maybe that will be my first question to you. And if you can throw a little light around how did Macquarie structure its investment in Blue Leaf and your focus in Asia Pacific, because we understand you're not working only in India, but in other countries in the region. So if you can talk a little bit about the platform and how is it that you're looking at opportunities in the region. So over to you, Pratyush. 5 minutes, please.
Yeah, thanks a lot, Namrata. Can you hear me all right?
Yes. Yes, please. Go ahead.
Great. I'm really sorry I could not be there in person, but I'm glad that I can join this illustrious panel and this great event which USAID is organizing. I mean, a lot of great points made by all the panelists before me. So I just want to reflect on a couple of points, especially what Mr. Gautam said, is that the access to clean, affordable, and sustainable energy is a need for about quarter of the population of the world in this region. And that's something we cannot negate. At the same time, we also are amidst a climate crisis. So let's not mingle words and say that there is climate change and we need mitigation. We are amidst a crisis, and the whole world and all of us need to concentrate our efforts to make sure that we are accelerating our transition to net zero, which is the only way to mitigate or potentially avert this crisis. Now, that exactly is the mission for Macquarie's Green Investment Group. So the story goes back about 10 years when Macquarie set up this specialist group of investment professionals in the green energy space by acquiring UK government's Green Investment Bank. And that laid the foundation for having very specific focused approach on creating platforms for investing into renewable energy and energy transition at different stages of business. Under the Green Investment Group, while it started off from Macquarie's own balance sheet in Macquarie Capital, where the balance sheet used to deploy capital, mostly development kind of capital into projects and companies across the world, and then eventually moved into the mainstream business of Macquarie as an asset manager, where Macquarie Asset Management is raising funds which have always focused on infrastructure as a theme, but now focused on renewable energy and clean energy transition. So recently they've raised two funds. One is a global fund which focuses on core renewable energy opportunities, which is the more established technologies like wind, solar, batteries. And then there's another fund, which is an energy transition fund, which focuses on new technologies and new business models like clean hydrogen, fuel cells, and everything else. So we, Blue Leaf, are a platform under the Macquarie's Core Renewable Fund. And now, knowing that renewable energy does need very long-term patient capital, one of the innovations which Macquarie has done with this fund, that this is an open-ended fund where there is no pressure on the fund manager to close the fund and give the exit to its LPs within, say, 10, 12 years time horizon, which a typical infrastructure fund has. So that gives the ability to all the investee companies like Blue Leaf to have capital which is really patient and act like not only a developer of clean energy assets, but also operate and maintain these assets for life with the same sort of capital without having another capital event or without having the need of another capital event in midterm. So that's what we are. We are a clean energy focused business, which is 100% owned by Macquarie's Core Renewables Fund. And our mandate is to invest across Asia, primarily focusing on greenfield investment. But depending upon the market's evolution and the opportunity, we're also looking at mergers and acquisitions and investing in, say, late stage development or operating assets. Our current remit is beyond India. We've got offices in 4 other markets. We've got Singapore as our headquarters, and we've got Japan, Taiwan, and Malaysia as the other markets where we're looking very actively at development opportunities. So the approach of setting up platforms like Blue Leaf has been deployed not only by Macquarie but many other large infrastructure investors. What it does is that it allows the investors to to participate in greenfield investments where the risks are higher. You have to take care of the project development risks. And at that time, the risks are higher, and you need to be really more engaged with the business to make sure that the business is taking care of its development activities in a proper manner and ultimately delivering the desired outcomes on returns and projects. So Macquarie has invested into or even seeded certain platforms across the world. Blue Leaf's mandate is onshore renewables in Asia. There are other regional platforms like Aula Energy in Australia. There's another platform in Europe, another platform in the US. So these are region-focused platforms, but they've also set up certain technology-focused platforms like Choreo Generation, which is focusing only on offshore wind technology. So there's another one which is Eco Energy, which is just focusing on battery technology, where they are doing projects taking merchant risk with batteries. So what Macquarie is doing is that they are having this dedicated focused within these platform teams, which can fully understand and comprehensively use the risk-based approach of Macquarie and create results in those focused areas, whether it's a region or it's technology. What Macquarie has also done is seeded the key management into these businesses. I was earlier working with Macquarie's Green Investment Group, and then I joined Blue Leaf as one of the first employees. So that also provides the transfer of the investment mindset. And these companies are not only operating as developers, but they also have a mindset of a large infrastructure investor. So to sum up, this is actually a great way of attracting capital where established fund managers like Macquarie can raise capital from different types of investors on their funds and then set up dedicated platforms which are closer to the projects and investment opportunities and are delivered in a manner which cater to the requirements of the investors.
Okay, thank you so much, Pratyush. That's something very different, which brings us to a place where financing is not so much of an issue for you as an entity because you have a captive investor in the form of Macquarie. But what becomes more important is to ensure the execution is quality and on time. I think that is what then becomes the more important aspect for platforms like Blue Leaf. But I'll come back to you with the final question in just a bit. I'll move to our final panelist, Kushal, who's from Lightrock India. And Kushal, Lightrock, we believe, is a global private equity firm. And according to you, how do you look at the investment landscape in the sustainable energy sectors that you invest in? If you can talk about, the opportunities, the same question that I'd asked Satish, and what are some of the prerequisites for investment in the sectors that you are, putting in capital? If you can just shed some light.
Sure, thank you, Namrata, and good morning, everyone. So Lightrock is a global private equity platform investing across three themes: people, productivity, and planet. And planet is becoming more and more important. Just for context, we raised $860 million climate focus fund in 2022 for developing markets, and even in India now we are focusing a lot more on the energy transition side. One of the core themes that we are looking at is how does the last mile get better access to energy, and how does the last mile, all the energy that's been generated, like how do the last mile get transitioned from fossil fuels to clean energy? So a lot of focus on the last mile side. So the segments that we are looking at broadly include the residential segment, the households, the single entrepreneurs, the small and medium enterprises, etc. Because one of the challenges that we are seeing is that there's a lot of money that is flowing in towards, let's say, the utility scale developments, or a lot of capital flowing in towards the large CNI developments, because there you can actually implement large projects and have very in some kind of predictable cash flows in those segments. But when you look at the smaller segments, right, let's say a small factory requiring 200 or 500 kilowatts of installation, right? How do you underwrite them? What is the solution for them? And how do they get access, or how do they transition from fossil fuels to clean energy. Those are some of the problems that we are trying to solve through our efforts in this space. Um, so, uh, so as Satish mentioned, this seems to be one of the fastest growing segments that we can see. So I'll give you a small example of the EV space, for instance. 5 years ago, when we were looking at EVs, it was almost nascent, and there was a big question: will this work? Where will the infrastructure come from? Will the battery last? What is the resale value? A lot of questions that were coming through at that point of time, and there was a lot of uncertainty around some of these technologies. Now, 5 years, so the total percentage sales of EVs as a total sale of vehicles was, let's say, 1%, 2%. Suddenly, post 2022, 23, that percentage has scaled up to 6.5%. And we can see a steep curve. And we see this continuing because what has happened is that the inherent unit economics has started working out. Ultimately, it is the market, right? Like, see, subsidies and all these incentives can only take you to a certain extent. And let's just face one thing, that market is not going to adopt something just because it is good for the planet or good for sustainability. Markets will adopt something once the unit economics for the end user starts making sense. And that inflection point has been achieved in some of the segments. I'll not say all the segments, but let's say basic solar, EVs, etc. We are now seeing that inflection point having been reached, where unit economics is making sense for the end user. So the total cost of ownership for a commercial vehicle now, for instance, is making sense. And that's why we see that those segments taking off. Like, just to give an example, in 2023, I think 50% plus of the total cargo three-wheelers sold in India were electric vehicles. Now, that's a big vote of confidence to say, okay, for someone who is using a vehicle for livelihood, now moving to EVs makes sense because his total cost of ownership has come down. Now the challenge for investors like us is, how do we enable that single entrepreneur driving a vehicle to actually get access to that vehicle so that he can reduce his total cost of ownership and increase his livelihood while having a positive footprint in terms of the climate. And that are the kind of problems that we are looking to solve for. And those are the and that is where we see the inflection point having been reached. Similarly in solar as well, right? With the kind of programs that are coming through, and with the, like in India, like grid is supposed to have reached 99% of the villages, and almost 100% electrification is what is being claimed. And let's say even if the quality is not there, we see that in the next 5 to 10 years we will get to very high quality of grid. But then the question is, how do we get benefit of these of this? How does the last mile get benefit of this, and how do we make sure that they get? So now the payback period for a household to implement solar rooftop is less than 5 years. Now it makes sense that if you can get your payback in less than 5 years and enjoy low cost or almost free electricity for 15 years after that, it makes all sense to do it. And also our energy consumptions are going up. People want, let's say, again, to give you a very practical example, most people do not install an air conditioner, not because of the cost of the air conditioner, but because of the electricity bills that air conditioner will bring. But let's say if we are able to reduce that cost, or like the cost of electricity comes down through solar for the households, then we can actually help them move to usage of more electrical equipments, which basically have a positive impact on the quality of life of people. So that is where our focus is, and we feel that the inflection point is being reached in many of these segments. Where it has not been reached, we feel that in the next few years, we will get there as technology is improving, as costs are coming down. And that is what our investment thesis is. And we are seeing, and this is like, I hope with the help of a few examples, we can now see where things are moving towards. So, yeah.
Okay. No, great. Thank you so much for that, Kushal. And it's a very difficult segment that you're actually operating in. And that will actually bring me to the final round for the panelists before we open up for some question answers. And at least for, I'll reverse the round. I'll start with the investors in the room first. Just to ask you, and it's originating from what Satish you mentioned about, and what Dasho mentioned about the riskiness of projects versus, the need for concessionality or innovative structures that we look at in some of these, difficult clean energy transition sectors that we are working on. Also difficult, particularly from the country's perspective, if you look at the riskiness of certain countries in the region that we are operating in. So if I can start with this one question for you, if you can spend a couple of minutes, because then I'll have time to just take some question answers. So, and I'll start with maybe Satish, go to Kushal and then Pratyush, and then come back to Dashu, you and Arjun sir. So what is that, aspect which can break this conundrum between risky nature of investments versus making that investment possible? What are some of the innovative structures that investors like yourselves are either working on, or you have certain examples that you'd like to share with the group? So maybe over to you, Satish.
Thanks. I think in this whole energy transition, there are lots of newer things which are coming up as a potential solutions. But the business model for them is not proven, and you will be taking risk irrespective of the fact that the TCO for let's say, a commercial electrical bus stacks up vis-a-vis a diesel bus. That is not sufficient enough to say that you can operate and own and operate a bus transportation business or a shared mobility business using electrical buses. Because the whole ecosystem, for example, which is required to make that happen in terms of the charging points, boarding points, workshops, depots are missing. For airlines, we have airports. For railways, we have stations. For ports, we have, again, for the shipping lines, we have ports. But there isn't anything of similar nature for the private sector buses in this country where you can do that, and particularly when it comes to electrical buses. So that's one example I'm citing as an inherent risk which you have when you have to create something for the first time. And how do you mitigate that risk? There are many ways of doing it. Obviously, what Namrata was talking about was in relation to financial instruments. How do you really finance? What kind of a capital structure you put in? What kind of a first loss guarantee, if you can garner from somewhere, you can put it in. On the other hand, you can also conceive the businesses in different manner. And I'm going to give an example of our company Green Cell, where instead of relying on the specific financial instrument or a concessional capital there, we relied on a business model whereby a part of the business had a clear visibility of cash flows coming in through a B2G program of the Government of India, FAME2 it is called, which is a faster adoption of the electrical mobility in India, where you bid for providing services using electrical buses, and you are being paid in a gross cost contract on a kilometer basis. So you're not taking any occupancy risk. The concerned authority is also providing you the land for putting up the depot. So you're not, again, getting into the infrastructure creation of a major nature. They will provide electrical connection. So you install the chargers for yourself, and you'd install your own workshop and intermittent charging points. But if you have won the mandate in a competitive bidding, and obviously you will bid doing a financial modeling where you will provide for many unknown risks around it. And when you start executing it, you will have visibility for the 10 to 12 years of cash flow. Now in Green Cell, we operate 1,000 buses under this model. Based on that 1,000 buses cash flow comfort, we have embarked upon a much larger ambitious model of doing a intercity transportation. These are intracity bus transportation, which is the priority for the Government of India. For an intercity, there is no subsidy available from anybody. You have to create your own ecosystem of midpoint charger, endpoint charging, initial depots, boarding points. And as we speak, we have 250 electrical coaches operating on nearly 100 routes in India. And when we started to conceive of this business, we went to the existing OEs to seek a quotation for an electrical coach which can do 600 kilometers a day. And none of the OEs in India were interested in making that bus because there was nobody providing a subsidy for that kind of a bus. So we had to go backward, find a collaborator in China who was one of the largest producers of similar coaches in China, got into an arrangement, bought CKD, SKDs in India, got it contract manufactured in India, got it approved by the government authorities and labs for the roadworthiness, and then started the business, creating a whole digital infrastructure of ticketing, managing the depots, scheduling, everything around it. And this business over the last 1.5 year, 2 year, nearly now, is an EBITDA break-even level. It is still not a PAT level story, because the capacity when you create a depot, you don't create a depot for a smaller number of buses. You create a depot for a little bit large number of buses. So as we ramp up, obviously we'll start making the profits. But just one story that how have you been able to mitigate the risk of intercity electrical bus travel by combining it with the intracity bus travel which is having a long-term visibility of the cash flows. Thank you.
Thank you. Thank you. That's really very interesting. And I'll move to Pratyush. If you could spend just a couple of minutes, just sharing any examples of innovative transaction structures that you followed at Blue Leaf in any of your, existing projects that you're developing. Would you like to share with the audience here, Pratyush?
Sure, thanks for that. And I would also maybe echo what Ashwarya said a while back, that a lot of technology-based innovation is talked about, but we should also speak about the innovation which is being done on the commercial and financing side. So I'll share an example of a large project we are right now constructing in the state of Madhya Pradesh. It's a total 300 megawatt project, which has 115 megawatt of wind and 185 megawatt of solar. So it's a co-located hybrid project. But the unique part about this project is the way we have structured the commercial offtake of energy from this project. So when we started, being in Madhya Pradesh, it has good wind and solar resources, but also a very good complementarity of energy production profile, which makes it very attractive for certain large corporates who have their internal voluntary mandates to go to 100% RE very quickly. So with our relationships which Macquarie maintains, we reached out to a very large technology company, and they said that they were not able to buy renewable energy in India because of the regulatory constraints related to open access. So they are only interested in buying renewable energy certificates, and but they want to get into projects very early so that they can assist the projects getting to financial closure. So we engaged for quite a few months with this company. I can't disclose the name right now, but we signed up a 15-year contract under which all the environmental attributes generated from the project will be sold to them at a fixed price. And by environmental attributes, this project will be registered at the International Renewable Energy Certificate platform. And every unit of energy we generate from this project will get a commensurate unit of certificates. So we sold the certificates in a sense for a very long period of time, but then we were left with what you can call brown power, gray power, or black power, because it does not have the same energy attributes, and any buyer of this power cannot claim this as buying green power. So the market opportunity in India for such kind of power is limited. But I must bring out to the attention of the audience here that the Indian power market has now evolved, and the exchange has become deep enough that we felt that we could potentially take a market risk on the power price and continue selling this power on a day ahead basis. So we would have a long-term contract for attributes, which gives us the base revenue, but still we would have some market exposure. And to some extent, our owner, Macquarie, was fine with it. But when we went for financing, we realized that lenders were okay to take some amount of market risk, but this amount of market risk was a little bit too much for them to digest. So then we reached out to one of the largest power traders in the country and structured a power purchase agreement with them where they would sell this power on the power exchange, but they would take a risk view and provide an insurance price or a floor price to the project, that if the prices in the market fall below this floor price, then they would underwrite that price. And if the price is higher than the floor price, then the benefits would be shared between the project and the trading company. So by this, we were able to create an insurance mechanism and a fallback price, which the lenders were able to take view of and provide us a 75% debt for this project. The funding has been done by Axis Bank, which is one of the large private sector commercial banks. And we were able to financially close this project. Now, the beauty of this commercial structure for the project is that if you look at other alternatives of power purchase agreement, we have power purchase agreements signed in nominal prices. So there is no inflation adjustment in the power prices we get in the PPAs in India. And with that, you don't have the ability to make use of whatever inflation we would see in the power prices. Now, with this structure, we are able to have a project where we will get some inflation protection because the market prices will go up and adjust to inflation, and that will provide us relatively superior returns compared to the typical PPA mechanism. So I feel that with the more evolved and deepened power market in the country, and that's extremely important for any country's growth on the power side, we are able to structure such products and enable more capital coming into the country and supporting the transition to net zero. And we've attracted $235 million of capital in this project.
Thank you. I mean, that's really, really interesting, Pratyush, and that brings out really the power of markets. And I'm just going to use my moderator hat and cut down the India discussion, move to Bhutan and Nepal now, and then wrap up the session. But given the importance of markets that we've heard about and, the importance of therefore interconnecting the region more and having markets accessible, I'm going to move to you, Dasho, on the final question, which is to share your experience on anything that you would like with the audience with regard to either international capital raise, access to markets, for your projects. So over to you.
Thank you. I think two experiences that Bhutan has had over the last couple of years, mainly because of COVID. We started to think that we should not continue with everything that we're doing in the traditional way, and that some of the projects that we need to invest ourselves in terms of not only finding out where we are moving, but also in terms of building our own capacity, not only at the level of design and engineering, but also in construction management, and also, of course, the traditional way of doing operation and maintenance, which we are fully capable of doing at the present time. So we started small. So we started to do hydropower projects which are 100 megawatts and below, which we call small hydropower projects, phase 1, phase 2, phase 3. And we have been very successful in finding the financing and also finding the local capacity for construction and local support for design, engineering, and other support that we are requiring. So I think this has been a success story for us. And I think one thing that we learned from it is that if you wait to do it the traditional way and not transition, you will always stay there. You will always be making some form or other of an excuse that you're not moving forward. And I think this has been an eye-opener for us. And we have now continued to work on this, phase 1, phase 2, and each phase we are increasing the size of the project. We continue to call it small. We started at 5 to 20 megawatts. We are now up to 100 megawatts. But I think this has been one of the things that we have succeeded in. And also when you look at the debt financing institutions, people trying to find our own equity also, it is much more simpler when we started it small, and we hope to grow on that. Second thing that we have also realized is that when you have 20 to 25,000 megawatts to look at, that we need to change our own way of looking at the way of taking these projects forward. And we have decided to diversify, not only in terms of the energy source. I think we must, one thing make clear is that it is clean, renewable. Both Bhutan and Nepal, I suppose, in hydro and solar that we are investing in. We are not investing in any thermal as such, but thermal, of course, the ground thermal temperature difference, that thermal is renewable, but we are not into coal and LNG and other investments. But the investments that we are making into renewables, we are now expanding to solar. We are not going to be dependent totally on hydro anymore. So we are going for a hydro-solar mix now. And from the 20,000 megawatts that we are mentioning, 15,000 will be in hydro and 5,000 will be in solar, mainly because we have excellent sunshine during the winter months, and we have a lot of rain during the summer months, so they complement each other. And to a certain extent, that should resolve some of the market issues that we have. But the biggest decision that we have taken recently is that we will allow, as our friend from Evernorth Score mentioned, private sector investments 100% into solar. In hydro, we're still a little bit possessive, control possessive, I suppose, but we are willing to work in partnerships which we call strategic partnerships. So presently we are open to 49% investments in hydro through strategic partnerships, which we go out and seek in the world. And that has also recently seen a big jump in the number of people, firms, interest groups who are interested to invest in Bhutan. And so we have seen a lot more interest in people coming forward to say that they are now willing to come to Bhutan for investments, not only because we are not only looking for debt financing, but also we are looking for equity partners. So I think those two experiences that we have had over the last couple of years, and of course in the private financing in the last half a year or so, I think those are encouraging, and we hope that we'll push these regulations forward to achieve whatever targets we have set. Thank you.
Thank you so much, Dasho. That's really heartening to know about Bhutan's plans. And final question to you, Mr. Gautam, similar in terms of any experience from Nepal and HIDCL that you'd like to share with regard to where you have invested in projects where you've used innovative financing structures, or something that you're likely to do in the coming times that you want to share with our audience.
Thank you. I'd like to share one, two relevant with example. And the first one is that recently the central bank, Nepal Rashtra Bank, has allowed us to issue the green bond. And if we issue the green bond, and which is subscribed by the other bank and financial institution and the other contractual saving organization, it shall be counted as the financing by them to the energy sector. So it is a good financing modality for raising the public fund as well as the fund from the bank and financial institution without the low risk. That is one example. The second example is that the HIDCL is playing the role of leading in the financing in the energy sector with the local as well as the international players. I would like to give one very relevant example of the blending of the concessional financing and the commercial financing in the Upper Arun. Upper Arun is the government initiative project and the national pride project of the government of Nepal, which is the largest project with the 1063 megawatt. And in this project, the consortium is formed by the World Bank, ADB, and other international lenders, and which is the supported by the local financing arrangement by HIDCL. So that type of the blending mechanism can be developed or is developed. That is the second example. And the third example is that we can take the example of the financing the cross-border transmission line, Dhalkewar Muzaffarpur. That is a good example of the financing modality, and in which the local partner NEA and the HIDCL are there, and from the Indian counterpart there is the power grid company is there, and the appropriate financing modality and the other mechanism is developed. These are the good example for sharing, or the good example for, or the best practices adapted, which can be adapted in other project as well. Thank you.
Thank you so much, Mr. Gautam. And just in the interest of time, we will have to close this panel now, but I'm going to open for just maybe 2 audience questions if you have, because we have a great panel here. And then maybe I will hand it back to Mayank. I can see 2 hands which have been raised. One here, maybe Ranju ma'am, and one there, Rajiv, sorry. We've picked up 2 already. If you could please direct the name of the panelist to whom the question is raised to.
Namaskar. I have question with Agrawal sir. I just want to ask, because you have the zero emission target by 2070, and there is in all sector government has certain target to meet. In the banking sector, is there any policy to invest in the green energy, or it is all the market driven?
So there is a push towards pushing banking also to invest towards the green. Like I can talk about a specific example, which is under the Prime Minister's Surya Ghar Yojana, which is how do you incentivize installation of rooftop solar in the residential segment. The government has come up with a large incentive policy, which is almost $9 billion across various programs, including subsidies for installation, including awareness, and also pushing PSUs to invest in this. So if you look at a sub 3 kilowatt installations in the household segment gets a 7% loan for a 10-year period. Now that is a significant benefit that the banking, that enables the residential segment to adopt a solar rooftop, because with a 7% loan and for a 10-year duration, the monthly outgo towards the installation comes down significantly, almost 60-70% lower than what your electricity bill would have been. And that kind of incentives is coming up, where the banking sector is being incentivized to seed this. But at the end of the day, if we need to meet these targets, it has to be commercial, right? These can only be seeding or helping catalyze some of these transitions. But if for large scale adoption, it has to be commercial, right? It cannot just be subsidized. But the banking sector has been given, like, and from a priority sector lending perspective, these projects are falling within the priority sector for the banks now. And there is a clear push for the banking sector to focus on these segments.
Thank you.
Thank you.
Final question.
My question is to Pratyush. Pratyush, you gave a very interesting example of projects, green attribute being sold to a, let's say, corporate buyer, and the power is being sold in the market, and there also you have an arrangement with the trader to underwrite some of the risks. My question is, suppose, let's say, this project is structured in a cross-border context. Let's say, the project is based in, let's say, in Nepal or some other country, and that power is going to sold in the Indian market, and then you have a large corporate buyer, maybe in India, trying to create the green attributes. In such case, I mean, in your view, what could be the risk appetite of the lenders to tap into such projects in a cross-border setting? I mean, what do you think, how they will be open to take these kind of projects, maybe in a similar structure that you just highlighted for the Madhya Pradesh project? Thank you.
Sure, it's a tough one because I don't have knowledge about the financing regulations on cross-border. But if you look at fundamentals, this project was supported because of a relatively mature power market in the country. So it's very important that the project and its owners and financiers have the confidence that there will be enough liquidity to sell the power in the market. So if by cross-border you're referring to selling into the Indian power markets, one box is ticked because Indian power markets have matured, and there's a lot of progress towards even more maturity and deepening of the market. On the financing side, it is still not a mainstream transaction, and a lot of comfort for the lenders was also coming from the owner's profile itself. So Macquarie, being an owner in the project, significantly improved the overall risk profile for the lender. So it will be important who the promoters of the project are. I'm not saying there is any recourse to the promoters, but the overall ability of the promoters to deliver and operate this project in a professional manner is very, very important for the lenders. So it's important that the sponsor profile is very good. And finally, there is a lot of restructuring and detail in the transaction documents, which needs the stakeholders to have the confidence that such structuring is enforceable in the market. So depending on the market we are operating in, if there is history or at least a legal provision of enforcing these elements, then I believe both the equity and debt capital would be available.
Great. Thank you so much for that last question. And we will now close the panel. Thank you, distinguished panelists, for joining us for this session. I'll hand it back to Mayank to close the session then.
Thanks, Namrata. I think it was, thanks for moderating. I think to circumvent and, talk about and trying to bring a consensus on such a, panel is always difficult. But Thanks for this. And yeah, I think in the interest of time, I'll just call Mr. Bhaskar Raja, the team lead for India Pacific Office, US at India, energy team lead, to deliver the vote of thanks.
Good morning. Was the session useful? Yes, okay, thank you. What we have found over the years, over the last few decades, is that estimates of investments are an estimate. And after a few years, the investment levels go up, as our panelists also mentioned. Is there enough money in the market for all of our needs? No. No one country or one organization would have sufficient funds for the energy transition that is required worldwide. And that is the approach of USAID, that partnerships are the key. For over 70 years in India and over 30 years in the energy space, USAID has promoted partnerships. Partnerships between private sector and public sector. Partnerships between innovative technologies and the market. Partnerships between countries. And the South Asia Regional Energy Partnership, SAREB, is a partnership in the energy sector. I want to commend Mayank and the SAREB team for putting together this innovative financing partnership discussion here today. I hope that the investment facilitation platform that was launched in this SACEF to 2024 would be useful for all of you. I encourage more of you to utilize the platform, and if during the next day or so, if there can be discussions amongst ourselves, and to see if the investment community and the people who are looking for investment can sit together, and if we can promote one partnership that goes into real investment, that would be great for accomplishment. Thank you all for being here, and thank you for the ideas. Look forward to more discussions over the next half a day. Thank you.